All right, so um, this is the first unit of the financial modeling course, and excuse me. Thank you for those who attended on Thursday, and if anyone else can make it, I highly recommend coming in person if you can, because I can answer questions and go through things in a little more detail. So what I'm going to do here is I'm going to go reasonably quickly through the model, and you should be able to follow along. You can slow it down and go back, and I'll try and make it as clear as possible, so I won't try to go too fast. But I mean, that is why I prefer if people come in person. So we didn't really cover nearly the full model on Thursday, but I will go through and build out all of it today for you. So we'll get started here. So first off, what we're going to do is we're going to build kind of an assumptions page. So like this, assumptions. And for now, let's just make it about this big. So you're going to hit merge and center. I'm going to color this. You can color it whatever color you want. Make this white. I'll bold that. I'm going to put a thick border on this. Also, so I'm going to move this zoom stuff. I don't like grid lines. So these, I don't like working with them a lot of the time when I'm building a model this way. That's the other thing. You can build models in different formats. Some people like to have different tabs, which is what I do for my job. We have different tabs open for different. So this could be, let's say this is a business, this would be income statement, and I'll make another tab. This would be balance sheet. This would be statement of cash flows. This would be the forecasts. But I think for the sake of this first unit, it's going to be easier for you to see everything on one. And then we'll see later on how we can divide up this, because this will go down multiple rows here. So we'll get to that later on. But so I'm going to put in a first few items here. So like the listed price of the property. Then I'm going to say capital expenditures. Okay, so I probably spelled that wrong. If you ever worried that you spelled something wrong, hit F7 and see it comes up with this here, and then you go change. I'm not good at spelling, so I use this all the time. Then we're going to do something called a custom format here. So you can go to home, and then you can hit up here, or you can push Control-1. That brings this up, same thing. So I'm going to do a custom. I'm going to get rid of general. And in here, I'm going to put 0. Zeros, you could put any number in here, 8, but I'm putting in 0%. It's just putting in a plug number for there. And then I'm going to put a quotation mark, and I'm going to write debt. Now, this is very useful sometimes, because so 80% debt, that's pretty comp standard. If you're in real estate, putting 20% down is going to avoid private mortgage insurance. So that's why it's normally put down. Normally a bank's only going to lend to you if you put 20% down, especially for conventional financing. So that's why that's there. Now, the custom formatting is great because in this cell, it doesn't include debt. Like it has it written down, but it doesn't include it in the formula. So I can have 80% debt there, but then I can still do 1 times, or no, here, 1 minus, oops, sorry, equals 1 minus this. I get 20%. And it has this, it's copying the same formatting, but it makes it easier because if I just put in here, let's say I put in 0.8%, oops, and I tried to write in debt, okay, and then I tried doing equals 1 minus this, it doesn't work. So that's why I do this, okay. So here I'm gonna do 1 minus, oops, I can do that all the time, there. and I don't want this to say debt now, I want this to say equity. Okay, cool. And I'm going to align those there. I'm going to put in valuation date and exit date, and the square feet of the subject property that we're going to analyze. Bed, bath, just for comparison to other ones, properties that we're going to look at. So building value and then a land value. Okay, so now the building value, we're going to just make an assumption of 80%. I think that you get to, I wouldn't say decide, but you get to kind of allocate that the tax reporting purposes when you buy a property. But I think the IRS generally likes around 80% building to land value. So that's important because we can't depreciate land. We can only depreciate the building. So whatever this price is, say it was 100,000 and this is 80%, we can depreciate 80,000 over 27.5 years. Land that doesn't depreciate, you know, that's pretty self-explanatory. Okay, so, and then I'm going to build one more thing because we can, actually, I'll come back to, no, I will. Okay, so we're going to do rent comps down here. And I don't want to do this again, so I'm going to go format painter, and I'm going to do that. Perfect. And then I'm going to, down here, I'm going to do comp number one, copy that down to about, let's say, if we can find 7. Up here, I'm going to go rent amount. Over here, I'm going to go square feet. Okay, so this is overlapping here, so I'm going to do something up here. I'm going to double click that. It's going to move that and auto format it. Bed and bath. Then I'm going to do an apostrophe plus / minus. The apostrophe is just to tell that plus is not a formula, it's a string. So a string means like a word when you're talking about coding. And then we're going to do dollar adjustment. And then it's going to be square feet again. That is because when we do this comparison between other properties, there might be certain features in the property we're analyzing that's better or worse than our property. So we want to normalize that to get it somewhat in line with what we're looking at so we can get a fair rental amount. So hopefully that makes sense. Okay, so this next part we're looking at is, okay, so I'm going to have to share. I'm going to have to do a new share. Okay, so hopefully that's working here and this is clear. So I'm on Zillow now, and I've already picked the property. So sorry, I didn't even say where we are, but looking at Oklahoma City, just up the road from where I'm recording. Well, not up the road, 2 to 3 hours away, but there's a lot of comps around here that we can look at, but I picked this property here. It looked pretty good to me for this analysis. Now, I'm not making any investment recommendations here. This is just for educational purpose, but this looked like a good property to analyze. It's looks pretty nice. Looks like it's been recently renovated. I would assume that there's not going to need any capital expenditures made. We can start renting this out as soon as we acquire it. So we have the price here, so we can start filling out some of this information. So 159,500 capital expenditures. I'm going to do something here called, oops, I just realized I need to go back to screen 1. Okay, back to here. Okay, so I put in the price here. Capital expenditures, I'm going to go to move this out of the way. Data validation. I'm going to go here. I'm going to do a list, and I'm going to put in here yes. So you have yes or no in here, so you can make a list like that. And then I'm going to put a border around there and then make that like that. So I'm going to assume no for here because, like I said, that the property looked pretty good, looked in good shape. So here I'm going to anchor that with F4. That anchors the row and the column. If you change where these is positioned, it might anchor just the column or just the row. But we're going to anchor, all of that. We're going to multiply that by the amount of debt. Then I'm going to copy that down. And so what I did there is I did Control C. I went down, I did Alt ES. And I just copied the formula, because if I copied all, it would have had a border that the border sitting around the top there fill in here, and I didn't really want that. So I am going to copy I'm going to do copy that formatting into there. Okay, so we're good there. For the sake of this, I'm going to do the valuation date as of 12/31/2021, because when we do the returns, I just want it to be yearly for now. I want this to be clear for the first unit, so I don't want to have to be dealing with like partial discount years and everything. It can just be a little bit more confusing. Okay, so here I'm going to do EO month, and I'm going to reference the valuation date and the exit date. We're going to do a five-year return. So we're going to do 5 times 12, just, 12, this is a month formula. So we've got 5 years and obviously 12 months in a year. So that's going to give us the amount. That's in a number. Don't want that. I want it in the date formula. So there we go. So I just did format painter again. Square feet. Our subject was 1139, and then it was 3-bed, 1 bath. Building value, we said again, 80%. This is 1 minus that. So cool. All right, so down to the rental comps. I'm going to go back to the Zillow screen. Okay, so I'm going to go back here. Hopefully that's showing up. And so we're on buy right now, and we're over here. So we're going to go to rent. Hit rent. There's a lot of ways you could find out rental values. You could pay for software that gives you rent comps, but this might not be the most accurate way, but it's the fastest way to teach this. So just getting used to where you can find some of this rental data. So we've got one here. So 3-bed, 2-bath, 1,600 feet. Let's have a look. So let's see if I can share both screens here. Not going to allow me to share both right now. Okay, let's see if I can pull this in here. And actually, I'm going to go back here. Okay. So sorry about that. I'm just trying to. Okay, so we're on sheet 1. Okay, so this is probably going to be the easiest way to do this. So the monthly rent is $13.50, and so I'm on Zillow, look, just getting the data. It was 1,600 square feet. It was 3-bed, 2-bath. The profit, it does have 2 bathrooms, so that's something that our property doesn't have, but the condition is not quite as good. So what I'm going to actually do for this one is I'm going to do a 5% upward adjustment. And then so what this is going to equal is this here, and it's going to be times 1 plus the adjustment, and then I'm going to divide it by the square feet. Okay, so we get that much per square feet, and I'm going to actually adjust this a little more. That's a little bit more comparable. Okay, so we did that. So what I'm doing now is I'm back on Zillow. I'll try to figure out for the future how to get both screens showing easily, and I'm just going to find more properties that are comparable to us. So the best way is to find it in the exact area. So if you can find it as close as possible to where your subject property is, you might have to expand out of that area, and that might require some adjustments as well. So if you're in a nicer area, you're going to have to do some downward adjustments to get it to what your subject is, because obviously rents are going to be higher in a better area. And so if your property is not in as a nice area, then you need to adjust that down. So let's see what I can find here. I'll find some more. Okay, so I found another one that's 1,400. It's 1447. It is 3-bed, 2-bath. So I'm going to do a -5% because it's pretty nice. Well, let's see. Then I'm going to copy this formula down. Okay, so we're getting that. It's a not quite as good condition, so I'm going to say it's level the fact that ours only has 1 bathroom. Okay, I know that's the same one. Let's see what else I can find. Okay, I got another one here, which is 1659. Square feet is 17.4. 3.2. 0%. It's a little older, on the older side, so we're getting that again. Okay, I've got another one here, which is 1450. That's 102. Only 2 and 1, and it's in a slightly better location, so I'm gonna not make any adjustments here. Okay, so we're getting a bit higher on that one. Okay, I've got a 1295. It's 900 square feet, and this one is 3.1. And yeah, it looks pretty comparable, pretty similar to our property, just smaller. Oops. But the square feet adjustment will level that out for us. So yeah, you can see that one's got quite high rent. What else can I find? And let's try to get one closer to our subject. Another one here. It's a nice property, 1,700. It's 1925, decently sized. 2. I'm going to do a -10% because it's in very nice condition, and it's got two bathrooms up there, and it's got a nice balcony out there, so we don't have that in ours. Okay, let's find one more to add here. Okay, here's another one. So I've got 1595, and it's 1442, 32, make it negative 10%. Okay, got that there. And so we're going to do average. So it's equals the average of all these. Okay, so the $0.06 there. Standard deviation. Just to quickly look at the standard deviation. It's a sample because I took it from a sample of properties, not every property in Oklahoma City. Okay, so we're going to have +2, -2. Now you could do, sometimes I do the same thing as I did up here, but I'm just trying to get through this quicker right now. So I'm going to do this plus this, and I'm going to anchor that times this. Okay. Okay. So all our properties are good. We're within 2 standard deviations. Everything is in here, so we're between the bounds of. It wouldn't make sense for there to be a negative red, but that's how it came out. So nothing. This one gets somewhat close to that upper bound, but it doesn't go over 2 standard deviation. And you remember from your stats class, 95% of all data will be within 2 standard deviations of the mean. So that is correct within all our data is within 2 standard deviations of the average here. Make sure I got that right. Okay, cool. Right, so our subject is going to equal, okay, and then actually I'm going to move monthly. I'm going to push shift this, and I'm going to move that up, down one, just so it looks better. So what we're going to do is we take our average. This is the whole reason we did this. And then we're going to multiply it by the square footage of our property. Here. Okay. And then annually it's going to be that times 12. Okay, so we got 1207 for rent. And let's quickly just go back over to Zillow. Okay. So we're going to go back to our property here that we looked at. Okay, we got our property right here. Okay, we get a monthly cost, and then, okay, this is the estimated rental. We've got so nearly 1,200, pretty close to it. And what did we get? We got 1,207. So we're pretty in line. This is just an estimate, and Zillow uses some kind of algorithm to figure this out. And so we're within what Zillow is giving us. So we can be pretty happy with our estimation there. Okay, so I'm going to go back to the screen here. Okay, so we're back over here, and I'm just going to tidy this up. So you can do this in different ways, but I'm going to do it like this just for now. Okay, and I'm going to copy the formatting from there to here. I got rid of the border there, so something that it copied the formatting because there's no border up there. So gotta watch out for that. We gotta make that a couple more decimal places. Do the same thing for there, and it's done that again. Okay, and it's going to do the same here as well. And so we need to make this bigger. don't know why it's not working. Here we go. Okay, there we go. And let's do the same here. Right. Cool. So we're getting some information now. Now we're going to do our expenses. Okay. So expense assumptions. So what we're going to have here, we're going to have property tax, we're going to have insurance, and we're going to have repairs and maintenance. Change and change. Okay, and you could, there's going to be probably more expensive. That's why I added like a miscellaneous item, because yeah, I mean, what do you got? Maybe keeping the property looking good, just random stuff that you know might come up. Now, some people might also have property management, and we're going to assume that this is a kind of like just a small property. We don't have a whole lot of management needed, so we're not going to include that for this analysis, but that likely could be something that needs to be included. So property tax, I got the latest value. So I'm trying to get quickly through here. So in class, I showed how to find the property tax amount. Same with insurance, and the repairs and maintenance are based off a kind of an estimate of what the value is. It's normally about 1% of value, and then I put in 1,000 for just random expenses. Okay, so we got that built out. And do this. Okay. Now we're going to move on to financing. So we're going to do debt and capital. I'm going to put this CapEx now. And CapEx estimate. CapEx funding. And then I'm going to copy this. So put my border. And I'm going to put in total debt. And then I'm going to do total equity. And I'm going to build in the interest and the term. Okay. So debt is going to equal this times, okay, actually no, we already did that. So we're just going to go up to here. Capital expenditure. Okay, so it's going to equal that. Okay, so let's do an if statement. Equals if this equals yes, then the value will equal estimate CapEx. Value is false, it's going to equal let's do none, because the false statement is going to say no. It's the same thing. So none. That works. Now if I change this up here to yes, this changes to estimate capital, and then you're going to put in the estimate down here. Okay, hopefully that makes sense. If statements are great for financial modeling, you'll use them a lot. So the funding will just equal, so here we'll do equals 0. So the funding is going to equal this times this. I forgot to anchor this up here. It's 4. Okay. And total debt's just going to equal that plus that. Same as equity, that plus sorry, that plus I didn't build any equity. That plus that. Okay. Now, the interest rate, usually the prime rate, which is the kind of the rate someone with very good, like, perfect credit would get on a mortgage, is about 200 basis points or 2% above the 10-year treasury rate. So I think when I looked at this from December 31st, 2021, it was around 1.5% the 10-year treasury. And so 200 basis points above that would be 3.5, which was about what I think interest rates were around 3.5%, 4% at the end of last year. So I'm going to put 4% as our assumption here. And so that's probably pretty, if we've got, if this will change depending on the person to person, but let's use that for our analysis. And third, we're going to assume a 30-year mortgage, okay, because this is a rental property, and debt is, debt creates us cash flow here. It helps us. Okay, 30 years. Cool. So now we're going to build the debt schedule. So here I'm going to put in period. Actually, down one more. Period. And I'm going to put in beginning payment, interest, simple, and ending. And now I'm going to put in a 1, 2, 3, 4, 5, 6. Actually, no, sorry. Equal 1, 2, 3, 4, 5. That'll make more sense later on when we get to it. Okay, so the period we're going to put in 1, and then, oh, by the way, I said 30 years. For this, we're going to just assume annual payments, even though that's unlikely. You'd probably have monthly payments, but for the analysis, it's not really going to change a whole lot. I mean, there'd be some minor differences because of compound interest, but it's not going to be detrimental to the value of this. So it's easier for me to show you this when it's all there. So I'm going to go to columns because I want this to go down, and the step value I want it to only go up by 1, and then I want it to stop at 30. So that goes ahead and fills that down. And then I just want to probably center those. Okay, so our beginning balance is going to equal the amount of debt. The payment is going to equal PMT. Oops. PMT, the rate. This is monthly. We're going to divide that by 10, but we don't need to do that here because it's already on an annual basis. We did the number of years. Present value, I put a negative because we got to. That's going to a cash. It's going to be like, well, so it's, for us it's going to be cash inflow, but I want these to show up as positive. I want the payment to show up as positive, even though we're paying it out, just so it looks better on the schedule. So I put a negative PV, present value, which is this amount here, the amount of the loan, and then the future value is 0 because we're going to pay it all down to 0. I'm going to assume we pay at the end of the month, so we get an annual payment of that. Now, if I put the present value as not negative, this would come out as the same number, but just negative. So that's how much we're going to be paying every year on this loan. And the interest equals the beginning balance times the interest. Pretty makes sense. Doesn't the principal is just a difference here. What you paid in interest on the pay, difference between how much paid in interest and the actual payment, because that's going to pay down our actual loan amount. So then that's just the beginning minus the principal. There we go. And then this is going to be the beginning next year is going to equal the ending of the previous. So I'll pull it down there, down, down. Okay. So I obviously didn't anchor something. Okay, so here, this, I gotta go equals that and anchor it. Okay, cool. Now we're good. And here, and then now I can just do this whole thing. Now, this always, you know this worked when this equals 0. If it doesn't equal 0, you've done something wrong. Okay, so it's an easy way to figure out if you mess something up. Okay, and let's center those. And let's give this a border. And then let's give the whole thing. Let's do all borders. Oops. Oh well. And then let's do a thick border on the outside and around there. And then let's make those bolded. And let's actually go that. So that's clear. And I'm gonna, you can do whatever you want here. This is just what I like to do. Let's do it that color. Okay. So we have our debt schedule built out. Okay. So next we're going to be building out the forecast. Forecast assumptions. Okay. Let's do that. Great. So I'm going to build here. When do we want our date starts? We're going to do 5 years. This is 5, 4, 3, 2, 1, 0. So this is going to equal our valuation date. Where is that here? Okay, equals that. And then this, we're going to do a formula here. We're going to do if this, so we're going to do if EO month, this here was 12, okay, is greater than, there's multiple ways you could do this. If it's greater than our exit date, anchor that, then I don't want it to return anything. If it's false, it's going to just equal EO. It's going to simply equal what we just said. Okay. This needs to be the same. Oops, not copy. Okay, I'm going to go. Okay, so did that go up? 1, 2, 3, 4, 5, 6. And see, it stops here. Because that has 0. So that's perfect. That means it's working. So we have our dates built out here. And I am going to build this. So I'm going to do real growth rate. And then let's say strong base week. Now we're doing revenue growth here. So that's revenue growth. Okay. So here I'm going to do that data validation again. I'm going to do a list. I'm going to source it between these ones here. Okay. Let's give that a outside border. Let's make it bold and center it. Let's do base for now. And over here, I'm going to do if this equals strong equals 1. And if this equals base, it's going to equal 2. And then otherwise it's going to equal 3. So base, if I go to strong, it equals 1. If I go to weak, it equals 3. Okay, this will I'll very soon, and we'll see why this is important. So we've got the real growth. Real growth is without the inclusion of inflation. So, for example, if you have 8% return, let's say you invested in the S&P 500 and you earned let's say 10% annual return, but inflation was 5%. Now, just doing quick numbers, your real growth is around 5%, because 5% of your value is coming from inflation, because prices have increased by that much. So your real growth isn't actually that much. So you'll see here what we're going to do. So let's say for strong growth, we would have 10% growth, okay, across this amount of periods. Let's say our base growth would be based on like maybe the historic. Now the historical is going to be a bit distorted because we've had extremely like almost 20% growth in rents. So let's historically kind of say around maybe 5%. And weak, let's say there is no growth. Okay. And then what here we're going to include inflation. Okay. And I pulled inflation data estimates from, let me go find that. Where did I put it? Okay. I'm going to share this screen here with you. Okay, share. This is, so here we're looking at the consumer price index. So for 2021, we're looking for the future. So we're looking at, so actually I don't need data in here. Inflation is 6.1%. So I'm going to 6.1% for 2022. And then 2023 is 3.1. 2024 is 2.4. 2025, 2.3, and then 2.3, pretty much going beyond there. Okay. By the way, this is sourced from, this is free, get it from the Budget and Economic Outlook 2022-2023. And it's done by the Congressional Budget Office. Okay, let's go back here. Okay, so we got our inflation estimates here. I put them in there, and then so we're going to have our nominal growth. Okay, so this is going to be there's a couple of ways you could do this. So this is the way I'm going to show you how to do it. Okay, so it's going to be equals 1 plus, it's going to be choose. Function's called choose. The index number will be this number here. Let's anchor that. And then our value 1 is this, the value 2, and this is our value 3. Don't anchor those ones. Okay. Okay, so it equals 1. So this is not the actual formula here, but I'm just showing you how this works. So if I change this to strong, this changes to that. That's why we put a 1 in here, and then this is the value 1, value 2, value 3. So that's how that works. Okay, so let's build out. I want this back on base. Okay, let's build out the rest of the formula. So it's 1 plus that, and it's going to be times, let's not build it in there, it's going to be out here, times 1 plus inflation. And then it's going to be minus 1. Okay, so that's our real growth. Let's copy that across. And so that's our growth rates there. So in a week, growth, that's how much, we got base there. So I think this is actually a little bit too high, so I'm going to change this to 3. Okay. That's a little bit better, I think. Okay. Now we need to make an assumption. Again, I'm going to copy these. Okay. And actually, I need to move these down 1. So I'm going to do vacancy assumption. Now, with a single family kind of property like this, we would hope that there is no vacancy, but potentially there could be. So strong. Now, the strong is going to be strong means that like there would be probably no vacancy, you know, because strong is a good thing. Okay, make that 0%. Format painter. Okay, 0%. Okay. Base, let's build in a 5% vacancy. Okay. Okay, so we're good there. Okay. Okay, let's build in 5%. Okay, and then 5, 5, 5, 5. And then weed, let's say 10%. Let's formats, and then let's do 10. Okay. Then we're going to build the same thing here. It's going to be data validation. It's going to be a list. Source it from there. Okay. And let's see if this works. Control C. Okay. Okay, that seems to work. Okay, cool. So if I went weak, 3, strong, 1. Perfect. Okay, so now let us put in the actual vacancy rate. It's just going to equal the choose this, and it's going to be that. And keep doing that here. Cool. We got our vacancy rate built in now. Perfect. And then our expenses. Expenses. So we had our expenses up here. Yes, I just want to copy the values. Cool. We got them there. So expenses here, so we can build in what they were. Okay. Okay. Oops. That's going to go down 1. Cool. So for here, it's going to equal this times. We're going to assume everything kind of grows with inflation here. it didn't do is anchor inflation. So, okay, cool. So that's our forecasts done there. Now we assumed no capital expenditures other than what the property we bought. Here. Okay, so gap 27.5 years, how much you can depreciate a property by. And existing assets. Okay, so this one's going to be, it's going to equal times this. So depreciation is not going to kick in until the next year. So that's a depreciation. So if we happen to have any additions, we don't, but this is how it would work. Then what would add is if we had additions in if we had additions in this year, then it would be included here. So F4 divided by that. And if we had additions here, the depreciation would include in this year. So equals this. And we have total depreciation. And it's going to equal that. So if we had additions here, it adds into the depreciation. If I had additions here, here, and increases our depreciation expense. Awesome. Okay, so we have that built out. And now we can go ahead and build out So yeah, that's the dates again. Okay, and we're going to start with rental revenue. So here we equal hang on. We did here is going to equal this that times 1 plus our rental growth there. Okay. So build that in. Vacancy was that times our vacancy, that assumption. Okay, and then we get our net rental revenue equal rent is vacancy. Okay, and then we're going to build into our expenses. I guess I already calculated, didn't I? So we can just, I guess, yeah, we'll just copy them over then. Again. Like that. There we go. Okay. So, and then I'll do a total expense column. It's going to just equals to do alt equals to sum all them up. See, over to total expenses, and then we're going to do very important value in real estate, net operating income. So for our net revenue minus our expenses. And so if you're familiar with finance, doing business valuations, net operating income is the same as EBITDA. And so this is used in conjunction with, especially in commercial real estate, with cap rates. So cap rates is take the so cap rate equals the property value. That net operating income, this here, divided by the property value, what it was paid for, and so then you'll get like 0.05. And so then what you do to get this is you would divide this by that, and that gives you an estimation of the value of the property. So cap rates are used to determine the value of an asset using comparables. So it gives you a comparable valuation. Instead of doing a DCF, it's called the direct capitalization method. And so appraisers use it as one method in conjunction with precedent transactions, so properties that are sold, and then they compare that with the DCF, and they have those kind of assumptions to, you know, see what the valuation's at. So we have this. So what I didn't build in here is our first year. So actually, I'm going to do that here, so we can. Okay. And let's do oh, this first year I not have a cap rate vacancy. No, I didn't. That okay, and then let's do Control C. Oh, geez. All right, so now we can look at what is our cap rate for our first year, or when we bought it, sorry. Okay, and so we're going to do equals this divided by how much we paid for it. The this. Okay, so we get, yeah, like I said, we got what I could guess before, 5% cap rate. And so let's copy this across and see that our cap rate's actually increasing here because our income's increasing. So that's assuming that property value doesn't change. It's based off of initial purchase price. So because it's increasing, we would expect the value to increase because we're producing, the value of something is based off of how much cash flow it's kind of producing. So we would assume that this cap rate is going to come down now because the property is going to be older after this 5 years. And if we haven't made any expenditures to it, the cap rate's probably going to increase because there's more risk now because the next person who buys this property is going to have to put work into it. But there's also going to be appreciation in the area, so growth and everything. So I would assume that about a 5% cap rate for us selling here, and that's what I'm going to use for this analysis. So I'm going to put in here the exit cap. I'm going to do 0.05. Okay, send. Oops, yeah. Cool. Now I'm going to build in our. I'm going to do this in 2 steps. I'm going to do an unlevered returns. Okay, so I'm going to do net operating income. Take that across. Oops, I've done that like 4 times today. Okay, so oops. Take this down 1. So NOI. Oops. NOI. And then I'm going to less depreciation. So that's going to equal this. Oops, and we're building this for a 5-year. We're not including the year prior. Like when we bought this in December 31st, so our next income, our annual income, won't be until the following year. So we won't include the other year because we won't be getting any income from that year. We'll be paying for the property that year. So the total depreciation will be from 2022 and onwards. And what this will give us is our earnings before tax. This is on an accounting standpoint right now. So let's do this. Let's assume a tax rate of, I think, about 25%. So I'm going to do 0.0% for 25%, so 0% tax. Okay. Okay, so it's going to equal that times this. Okay, and that's going to equal net income. It's going to equal that minus that. Okay, and then we're going to add depreciation. Add this back because depreciation isn't, you don't actually write out a check or anything for depreciation. It's just lowering our taxes. We're adding it back to get our cash flow here. Now, in businesses, you got to adjust for changes in working capital and capital expenditures, but we have neither of those, so we don't need to worry about it. This is our cash flow here. So our cash flow, then we do firm, let's do cash flow to investor here. So net income plus depreciation. Okay, so there's our cash flow. Okay, and then let's do sale. Let's do, we call it disposition. So that's going to be when we sell the asset. And so it's going to equal NOI divided by our exit cap. That didn't work. That's, oh yeah, that's not our NOI. NOI divided by, I think, there. So let's do total cash flow. Total cash flow equal that plus that. There we go. And let's do IRR, internal rate of return. And so in the first year, we're going to have a negative cash flow because we're going to pay for the whole asset in cash because this first one is unlevered. We're assuming no debt. So we're going to pay for that whole thing up front. So full equity here. So equals, we're going to do this thing called XIR. So the values are these values. And then the dates equal these. So you can do that. So we get a nice 12.5% return, which isn't actually too bad for a full equity deal. Yeah, not bad. But I'm going to show you down here the levered returns, which is more important because this is what we really do in real estate. So again, I'm going to have copy. No, let's just build it in. You know why? I'm just going to reference up here to be quicker. You know why? This depreciation, and then I'm going to list interest, and then we're going to have tax again. Okay, I'll do that. And then Control C, and then we're gonna, and then less debt payments, our principal payments, and then we're gonna add depreciation. Back up here, depreciation. Okay, interest, we're going to do index. I'm going to go up here. This is our index. This is where we want to get information from. We're going to match it with, okay, so I haven't, okay, the date's up here. I needed to put the date up here. I'll get back to that. And the lookup array is going to be these periods. Anchor that. And I want an exact match. So it's going to return an error the first time I did it. I'll show you why. Because I haven't put anything in there. And I want it to show the interest That's why I put a 3 there. Okay. So in A, that's what it's showing right now. I need to put a 1, 2, 3, 4, 5. Okay, now it'll work. So it's showing that I have to pay $5,000 in interest in the first year, 5,100. And so I could have simply gone up here and selected that, but now I would have to do that for every single year, which is going to take time. So especially if this was a long model, this simply makes it easier. Interest, and so what our earnings before tax is going to be that minus that minus that. So actually we're not making money in the first year on the books. So here it's going to go equals if this is less than 0, and the value is going to be 0. Otherwise, it's going to equal that times that. Okay. Interest. And then we need to let's just go back up to total expenses, cash flow. Okay, you know why? Just making sure that's still correct. The operating income. $1,000. Okay. Right. So that's then we're gonna do the same. I'm gonna copy this actually. Except now it's gonna take that up to there. And I'm going to change this to the principal payments. Copy that across. Then add equals to depreciation. So equal that minus that minus that minus that minus that plus that. Okay. There we go. Okay, that makes sense. Yeah, depreciation is the minus depreciation. Oh, hang on. Depreciation. Oops, I've been referencing the wrong thing. That changes everything. Yeah, so sorry, I had that reference in the wrong area. My bad. And okay, so then yeah, we start making income here, and then my cash flow is increasing. Okay, there we go. That looks better. I just thought something went wrong. Yeah, always check your formulas. I make mistakes often. And then so then again, we need to add in our disposition. So it's going to equal, it will equal this, but then we also need to minus the debt outstanding. So I'm going to do the index formula just again to show you how to use it, because I mean obviously we do know when we're exiting, so I could have just referenced it once. Match. I want it to match that with this. I want an exact match, and I want it to reference the last fifth column, the ending amount. Okay, so that's how much we get after the debt's paid back and we get our money from the sale of the asset. So right now you're probably looking at this like it's the other way sounded like a better deal, but you'll see in a second. I think the total cash flow again is going to equal cash flow plus that. And so here, this is where it's important. The only amount we put into this is the equity. There's a big difference here. Nearly 160,000 and this much, because the rest is funded by debt, and we've shown those cash flows in here. So the IRR equals the XR and the dates are here. So look at that. 35% return compared to a 12% return. So, you know, this is why real estate can be a very, very, you know, powerful asset, because you're using leverage to create higher returns. So here you've only got 12 because you've funded everything by equity. So your initial cash flow is so much significantly larger than when you're using debt. Debt's also a cheaper cost. You know, equity holders are going to most likely require a lot higher than a 4% return, than because that's what we assumed as our interest rate on debt. So this is why debt creates such a higher amount here. Now, since we made this dynamic here, I'm going to show you how you can do this. If this is strong, this is strong. Now look at our returns, 60%, 25%. So see how I'm building in things like this can sensitize your financial model without you having to do a whole lot. So if I went to week, here, I didn't have to do a whole lot. It flowed through. See, that made a huge impact on our. So you can also see that revenue and vacancy are huge drivers of returns. So those, when you're looking at buying a property, you need to analyze, is this a good area? Does this have revenue growth? Is this somewhere that's growing? And does this area have a high vacancy? Because as you can see, from if it's strong, meaning low vacancy, high growth rate, our returns are 60%. Over here it was 10%, I think, with weak growth and a weak vacancy. So that's part one of this unit. Now you can tidy all this up, make it look nicer. I just wanted to initially, I'm going to do a part two later on today, and this got us there. You can see the finance side here. There's one that I want to show you, is called grouping. So I'm going to go select all of this. I'm going to go data, and I'm going to group it. So watch this. That comes up. Forecast, do the same thing. I like to leave one space. Group. Okay. let's have all this in one as well. Okay, so now you have it all kind of like that, and it looks more tidy. You push 2 and everything expands, 1 and everything else, and you can have just that section open. So it just makes it look tidier. So that is unit 1. Well, it's part of unit 1. I'm going to go over some more additions to this later on, but I hope you enjoyed that part, and we're going to have lots more. We're going to build on top of this throughout the semester. So email me if any questions over the model. I'm going to send this out as well once everything's done, so you'll have access to this. You can look back over and see how everything's done. And yeah, so thank you.